In the world of finance, most of what we look at tells us a story about where we've been. It's history. But what if there was an indicator that claimed to tell us where we're going? One that could spot trouble on the horizon long before it makes landfall. Well, today we're going to pull back the curtain on one of the most reliable and, frankly, most watched signals out there, the yield curve. It looks like a simple line on a chart, but believe me, it has profound implications for the economy, for the markets, and most importantly for you, the price of your home.
So let's just ask the big question right up front. Can a single chart, one single line, actually predict the future of something as massive and complex as the US housing market? I mean, it sounds a little crazy, doesn't it? Can it really give you a heads up on when to buy, when to sell, or maybe when you just need to brace for impact? The answer is more fascinating than you might think. Because this isn't about some kind of financial voodoo. It's about decoding the collective wisdom and, maybe more importantly, the collective fear of the entire global market, all concentrated into one single curve. So let's find out if this is all hype or if it's the real deal. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. All right, here's our game plan. First, we'll get into why this curve has earned its nickname as the market's crystal ball. Then, we're going to decode its shapes and what they're trying to tell us. After that, we'll forge that critical link between this Wall Street chart and your mortgage rate. From there, we'll see how those rates end up moving home prices. And this is the key part. We're going to look at decades of hard data to actually see the pattern. And finally, we'll turn all this theory into a practical playbook that you can actually use.
So, let's start with its reputation. Among the most serious people in finance, I'm talking central bankers, Wall Street strategists, top economists, the yield curve isn't just another data point. For many, it is the very first thing they check every single morning. Why? Because unlike almost everything else, which is like looking in the rearview mirror, the yield curve is forward-looking. It represents the market's real-time bet on where we're headed. And frankly, it has an almost mythical track record of predicting recessions, often a year, even 2 years in advance. And if it can predict a downturn for the entire economy, you better believe it has something profound to say about housing.
To really get this, you have to stop seeing it as just a dry graph of numbers. Think of it more as a living, breathing indicator of market sentiment. Let's break this down. Future growth, that's the entire market betting on jobs and company profits down the road. Inflation, that's its prediction for what your grocery bill is going to look like next year. And monetary policy, well, that's the market constantly trying to outguess the Federal Reserve's next move. So what you're really looking at is a snapshot of the market's collective brain, thinking about tomorrow. So let's get to the core of it. How do we actually decode this thing? It might look a little intimidating at first, but it really only tells two basic stories, one of optimism and one of fear. And once you learn to see the difference between those two shapes, you'll understand its powerful language. So what is it exactly? Okay, imagine you're lending money to the US government, the safest borrower in the world, right? You do that by buying a treasury bond. You could lend to them for a short time, say 2 years, or for much longer time, like 10 years. For making that loan, the government pays you interest. We call that a yield. The yield curve simply plots the yield you get for all the different loan lengths, from short to long, and then it just connects the dots. It is quite literally a picture of the price of money over time. The whole story is in the shape of that line. Most of the time, the curve is normal. It slopes gently upward. And this just makes sense, right? You would naturally demand a higher interest rate to lock up your money for 10 years than you would for just 2. That's just common sense. This upward slope is the sign of a healthy, growing economy. But every so often, something really strange happens. The curve inverts. It actually slopes downward. This means investors are so worried about the near future that they are demanding a higher interest rate for a short-term loan than a long-term one. Now stop and think about how backwards that is. It's like saying, I see a hurricane forming, so I'll pay you more to borrow your umbrella for the next hour than I will to borrow it for the entire next week. It signals an immediate, pressing fear of what's right around the corner. So think of the curve as a 4-in-1 diagnostic tool. In a single glance, it's checking the economy's growth pulse. It's taking its inflation temperature. It's trying to anticipate the Fed's next move. An inverted curve is basically screaming that the Fed will soon be forced to cut rates to fight off a recession. And finally, it's measuring the market's overall appetite for risk. A steep curve shows confidence. A flat or inverted curve reveals a desperate flight to safety. All of that is packed into one simple line. Okay, so now we build the bridge. How do we get from this abstract financial chart on Wall Street right to your street? How does it directly control the interest rate you'll pay for a home loan?
This is where the yield curve stops being some theoretical idea and becomes a very real, very powerful force in your personal finances. The entire global lending system is basically built on one simple idea. Because the US government is considered the safest borrower on the planet, the interest rate it pays, that treasury yield, is called the risk-free rate. This rate is the floor. It's the absolute baseline. Think about it. If a bank can lend to the super safe US government for, say, 4%, why on earth would it ever lend to a much riskier home buyer for less? It wouldn't. It just wouldn't happen. This sets the bedrock cost of money for everybody else.
The way your mortgage rate gets set is actually pretty straightforward. It's a three-step process. Step 1, the 10-year U.S. Treasury yield sets the baseline cost. Since a 30-year mortgage is a long-term loan, its rate is fundamentally anchored to this long-term government bond. Step 2, your bank or lender adds what's called a spread. That's their markup. It covers their business risks, things like the chance you might default, plus their operating costs and, of course, their profit. And step 3, you take that baseline treasury yield, you add the lender's spread, and that equals the final 30-year fixed mortgage rate you see advertised. It's that direct.
And this creates a direct, almost mechanical link. When the yield curve gets steeper, it means those long-term yields, like the 10-year treasury, are rising. And because of that anchor we just talked about, mortgage rates get pulled right up with them. Your cost to borrow gets more expensive. But when the curve inverts, it's because those recession fears are causing investors to pile into the safety of long-term bonds. That huge demand pushes their yields down. This puts downward pressure on the 10-year treasury yield, and as a result, can actually lead to lower mortgage rates. Okay, we've established the theory, we've built the bridge to mortgage rates, so now we connect the final and most important dot. How do these shifts in the cost of borrowing, all dictated by the shape of the yield curve, ultimately change the price of a home? This is where the rubber really meets the road. So let's walk through scenario number 1, a normal, healthy, upward sloping curve. This is what you see during good economic times. People feel secure in their jobs, wages are going up, confidence is high. But here's the catch. That very optimism causes bond yields to rise, which pulls mortgage rates up right along with them. And that creates an affordability squeeze. As rates climb from, say, 3% to 5% to 7%, the monthly payment for the exact same house just skyrockets. This pushes a lot of potential buyers to the sidelines. The bidding wars start to fade, demand cools off, and that rapid pace of home price growth, it hits a major speed bump. Okay, scenario 2, the curve starts to flatten. The gap between those short-term and long-term yields gets really narrow. This is the market whispering, hey, we're getting a little nervous here, we see slower growth coming. In this kind of environment, mortgage rates might stall out or level off, but they're still at a high enough level to keep affordability really tight. The market's previous optimism fades, buyer uncertainty starts to creep in, and home price growth slows from a jog to a crawl. And now, for the most powerful signal of all, the inverted curve, the market's big, loud recession alarm. Now here's the paradox. An inversion often leads to lower mortgage rates as investors run for safety. And you'd think, hey, lower rates, that's great for housing. But it's a trap. Because at the exact same time, two other incredibly powerful forces take over. First, the banks get scared. They start worrying about borrowers losing their jobs and defaulting. So they tighten up their lending standards, making it much harder to even get a loan. Second, buyers get scared. People worry about their own job security, and they become very hesitant to make the biggest purchase of their entire lives. This wave of fear and tight credit completely overwhelms the small benefit of slightly lower rates. The result? A net drop in demand. And that leads to a housing market that stagnates, or in some cases sees prices actually begin to fall. This is the yield curve's ultimate warning shot. If you're finding this breakdown valuable, take a moment to like, share, and subscribe. And remember, whether you're navigating a buyer's or seller's market, my team can connect you with a top real estate agent or a life insurance plan anywhere in the country. The links are in the description. So this table puts it all together in one place. Let's walk through it slowly just to lock this in. Row 1, a normal, steep curve. That means long-term rates are rising, which leads to higher mortgage rates. That squeezes affordability and slows down home price growth. Simple enough. Row 2, a flat curve. Rates get sticky, demand goes soft, and price growth moderates. And row 3, the most important one, an inverted curve. It signals future rate cuts, maybe a dip in mortgage rates, but the overwhelming risk of a recession causes a net drop in demand, and that leads to price stagnation or even declines. This is the central mechanism we've been building up to. All right, so far, this has all been a logical framework, right? It makes sense in theory. But the big question is, does it actually work in the real world? This is the moment we pivot to the hard evidence.
We're going to look back at decades of data to see if this pattern truly exists. This is where theory confronts reality. Now, before we look at the charts, there's one critical concept you have to get: the lead-lag relationship. The yield curve doesn't tell you what home prices are going to do next week or next month. It's a leading indicator. The warning signal flashes first. Then that signal has to work its way through the entire economy. It has to affect bank psychology, consumer confidence, and mortgage rates. And only then, after a delay, usually about 12 to 24 months, do we see the full impact on home prices. So remember that lag. It's key. Okay, here's the key piece of evidence. Economists are obsessed with something called the 10-2 spread. That's simply the 10-year Treasury yield minus the 2-year Treasury yield. Why those two? Because it's the market's cleanest measure of long-term optimism versus short-term fear. When that number goes negative, it means the curve has inverted. And when you look back through history, this uncanny pattern emerges. An inversion is almost always followed by a recession. It happened before the dot-com bust, it happened before the 2008 financial crisis, and it happened before nearly every other modern recession. It is a remarkably consistent warning bell. Now, what happens when we lay the housing market data right on top of that recession signal? Well, the pattern becomes crystal clear. Time and time again, about 12 to 24 months after the yield curve inverts, you see a sharp slowdown or even a decline in year-over-year home price growth. This isn't an opinion, it's a historical echo. The inversion happens, the economic clock starts ticking, and then, like clockwork, the housing market feels the effect. The visual correlation is just undeniable. The yield curve calls the turn, and the housing market consistently follows. And look, this isn't just us spotting a pattern on a chart. This holds up to serious, rigorous statistical analysis. In simple terms, when economists crunch the numbers, they find a clear mathematical link. A steeper, healthier yield curve today is statistically linked to higher home prices a year or so from now. And a flat or inverted curve is linked to slower growth or even lower prices down the line. The data absolutely proves the connection is real and predictable. So to make this a little more concrete, let's just see what a basic model using this relationship might predict. If we were to plug in recent average values for the yield spread, a model could spit out a specific forecast. For instance, it might calculate that given the current shape of the curve, we should expect national home prices to grow by about, say, 3.1% over the next year. This is how the curve gets transformed from a vague signal into an actual quantitative forecasting tool. Okay, we've gone from a theory to the mechanics to the historical proof. Now we arrive at the most important part of all. What do you do with this knowledge? How do you translate these big picture economic signals into a practical, actionable strategy for your own real estate decisions? This is your playbook. If you're looking to buy a home, start thinking of the yield curve as your long-range radar for affordability. When you see that curve starting to get steep, and I mean really steep and aggressively, that's a powerful signal that the bond market is betting on growth and inflation, which almost certainly means higher mortgage rates are coming. That could be a sign that your window of affordability is starting to close. On the flip side, if the curve inverts, it suggests a recession might be coming, which could eventually bring lower mortgage rates. But that comes with a huge trade-off. You'd be buying when economic risk and job insecurity are at their highest. The curve helps you see and understand that choice. Now, if you're a seller, the yield curve is your leading indicator for future buyer demand. When you see that curve flattening out and heading towards inversion, that's a flashing yellow light. It means the economic tide is likely turning. Buyer confidence is about to weaken, and bank lending is about to get tighter. It's a clear signal that the red-hot seller's market might be coming to an end, and that the era of effortless, rapid price gains is probably over. Waiting too long to sell could mean you're facing a much, much colder market. And for all the real estate investors out there, the yield curve is an absolutely essential tool for risk management. A deeply inverted curve should be treated like a 5-alarm fire. It's signaling a coming recession that's going to impact every single part of your business, from the cost and availability of your loans, to property valuations, to the strength of rental demand as the job market weakens. It's a critical input for assessing the risk of any new project or acquisition. To ignore its signal is frankly to invest with a blindfold on.
And so we end right back where we began, with a question. This isn't just some academic exercise. As we speak, right now, the yield curve is sending its own signals about what lies ahead. A message of moderation, of caution, of a shifting economic landscape. So having taken this deep dive together, the final question is a personal one for you. Armed with this knowledge, are you prepared? To stay prepared and ahead of the curve, make sure you're subscribed for more deep dives like this one. And for personalized guidance on your real estate or life insurance needs, click the links in the description below. My team and I are ready to help nationwide. Thank you for watching.